Hi, I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgren, founding CEO at Lundgren's Capital.
Welcome to Sound Economies with Mel and Peter, an East Meets West podcast by Lundin's Investor Insights. Here we share what we're focusing at in economies and financial markets from the developed and the developing world. Hi, Peter. How are you today? I see that you're on a trip. What's up there, Peter?
Yeah, it's some good days. I'm on the road,
Mhm.
out seeing clients, investors. That's always very good. Doing new business, but also listen to what they think, what they're doing. That's nice. So also, if the recording and the sound is a bit weaker, I apologize for that. But we hope everything will work as it is. Good. How are you doing, Mel?
Peter, we have a few publications that we have published and are underway. We have very recently published an interview with you, actually, about the company's experience trading and investing in defense companies over the past year or 15 months to be exact. So that's been picked up quite well by there seems to be a lot of interest actually about investing in the defense sector.
Yeah, yeah. It's also a bit on the agenda this week with investors. I can
Right.
so yeah, that was actually quite interesting. Yep. So it's a good week so far for both of
Yes.
us.
And actually, we have a few interesting topics for our episode today. We'll have, of course, the very fresh news of the progress in negotiations between the US and China held in
Mm.
London. So, a lot of chatter about how the tariffs will proceed. And
Mm.
then we'll also discuss the Chinese sovereign wealth fund that's been stepping up big time to stabilize financial markets in China. And then to neighboring Japan, which is looking to remove some exemptions for tourists, foreign tourists, as far as their shopping goes.
Yeah.
And heading to Europe, Blackstone is investing $500 billion in Europe over the next decade. So we'll
Mhm.
look more into that decision. And as usual, we will close with our global outlook. So, Peter, I'd like to get started with, of course, the very hot topic of US and China. After 2 days of negotiations in London,
Mm.
both camps are saying that they've reached a good agreement, but details have been scarce so far because both are saying that they still need the approval of their presidents to like formalize it.
Yeah.
Yeah, of course, sure. But the major, so far, what we've seen is the major discussion point was really like China's leverage about rare earth minerals. So they've virtually held off additional supply of exporting additional supply to the rest of the world, particularly the US.
Yeah.
And it's seen to be highly disruptive as far as the supply chains are concerned, particularly for cars, not just
Mm.
electric cars, but even the usual fuel-powered cars, as well as gadgets, smartphones, anything that runs on machines, basically. So it's said to be the secret, not so secret bargaining chip that Beijing is waging against Washington. And now we're waiting by how much the tariffs will be rolled back. We're
Mm.
currently at 30% on Chinese goods and 10% for US goods. But as far as markets are concerned, there has been some pickup as far as American stocks, but not so much for Chinese stocks, Peter.
Yes, of course. As the negotiations are heavily interesting. It is the two superpowers now getting around the table, try to strike a deal. Yeah. So that alone is interesting. I think the world would like some good vibes. Let's be honest. But if we zoom in on, let's take the Chinese angle. We sort of discussed it ongoingly. What the investors are looking for. So the investors going and looking into China. They want domestic Chinese progress. That is actually what is cheering up the Chinese stock market. If
Mhm.
US and China they find an agreement on the trade war, so to say, it's of course positive. I would imagine, unless it the Chinese
Mhm.
government steps very surprising bad terms. But we don't expect it to be sort of a game changer. Honestly, we don't expect it to be an event that could spark up the Chinese stock market. Investors, they want to see improvement done home by the Chinese government to move the Chinese economy on. And that is actually what we have in focus in the way of saying, okay, what is important. Of course, we look into these negotiations. The whole world does. We need to do it. It's on our agenda. It's on our table. But it is actually sort of the internal developments in China that is much more determined for lifting the Chinese stock market higher, if that is possible.
Yeah.
Chinese government is doing its work probably. Yeah.
Mhm.
So this is, I say, this is our take. As this is not to be too boring, but it is sort of our realistic view on what's going on in terms of translating into to the market impact.
Right.
Maybe if we're looking in as a domestic China, yeah, the public or the government fund, we could call it. It is sort of a fund, yeah. Huijin is actually almost more interesting to look into when we talk about the stock market, because we've seen some statistics now. Huijin is now used to intervene in the stock market.
Yes.
It has been used before. If we go back to, I believe, 2018, 15, 18 area,
Mhm.
they stabilized the market as well. It is not unseen before. It also in Japan is very
Yes.
well known. Years back, decades back, the post office, as it was mentioned, was big intervening in the Japanese both currency market and stock market, and that was actually the pension fund for in the postal section of Japan. So we see it in other countries as well. But honestly, we don't like public intervention in the stock market, and that is regardless in what kind of country it is. Prices has to move where they have to do and go.
Market driven, yes.
Yeah, and that might be painful now and then. The only place where intervention actually has a positive function, in my view, can be in currency market, but only in the situations where currency really is coming out of order.
Uh-huh.
Uh, and that happens rarely. Normally, if currencies they drop, it is due to traditionally domestic problems, economic problems, big trade
Right.
balance deficit. So, but there it can be helpful in specific situations. But but they have been intervening, Hujin, and that is big. And that is in the ETFs. They're buying ETFs. They're not buying single stocks. So they're going into the exchange traded funds, and the statistics shows that they have bought really massive last year.
Right.
But this vehicle also used for other purposes, and Chinese are pragmatic. So if they can use the same vehicle for several purposes, they do it. It is also acting as supporting, I'll say, particular states-owned financial enterprises. It can also be
Mhm.
banks. It's mopping up back credits that is on the balance sheets of some banks, maybe for particular to the Chinese provinces. So that is also seen in other countries. As we have seen it also during the financial crises here in Europe, that the governments they establish what we popularly call bad bank.
Mhm.
Nobody likes the expression, but it is actually where all the bad credits they end up. It also rescues banks so they don't go bankrupt. They are swallowed by these as a financial vehicles, governments owned, backed up, and all sort of the good part of the business is then sold on to other players in the market, and all sort of the credits that are the loans that are suffering, they stay in the bad bank,
Mhm.
and then this sort of asset manager, call it whatever you want, try to get the best out of it. So this is what is going on in Eugene, and they're very active. But as a, also they're intervening in the stock market. But it's predominantly also to support some of the listed financial companies as a and government owned or controlled. So we of
Mhm.
course observe this. We don't like it, as mentioned. And that's there's public intervention in the stock market. But this is what happens. And one day they need to be sold out again. So we will remember if the market gets too bullish, then there will be a big seller. So, but interesting and worth for investors to follow this
Yeah,
this.
that's a big jump, Peter. If I remember correctly, it was a seven-fold increase in ETF holdings over the past year. So that's very rapid, and
Yeah,
probably really a big chunk of that was just the past few months or of early 2025. So that's a really big position that they suddenly took and will likely let go of in the future when things look better.
good. So we have noticed that in our book somewhere.
Yes. I'll head over,
Good.
Peter, to neighboring Japan. So just a break
Yeah.
from all the tariff talks, but there's this move from some Liberal Party lawmakers proposing to end the duty-free perk given to foreign tourists who are in Japan or traveling in Japan. So their main arguments are really it's a tax leakage, basically, or a foregone revenues, but it's estimated at about $1.7 billion a year. Um, so when foreign tourists travel to Japan and spend at least 5,000 yen, so that's about $35. They're exempt from paying consumption tax of 10%, and then you can have it back, or it's even directly applied to your bill when you're checking out. So it's very easy to avail of as long as you have your passport. And now they're looking to remove it, saying there's some fraud that's happening in there, and that Japan has already established its name as an attractive tourist destination. It was a policy from 1952, so it was 70 years ago. But is it time to unroll that, and is it really, life changing as far as as far as Japan's finances are concerned? Not really. It's true that they have a very high debt to GDP ratio. They're above 200% as of last year, but $1.7 billion isn't much for an economy like that. And if they really want more revenues, I don't think that's where they can get it. Like, they do need support more, adult or aging residents. That's true. But the size of that is practically negligible. If it's one thing that keeps tourists coming, although we
Mhm.
do note that we discussed in many podcasts ago how countries like Japan and Germany are like rejecting tourists sometimes. Maybe it's more that than actually getting foregone revenues back to public coffers, Peter. So just something interesting to look at for Japan.
It is actually a bit interesting. So I suspect you won't go to Japan anymore.
I hope they don't pass it soon, Peter.
But as you say, as a 1.7 billion is nothing in the Japanese government budget or in sort of in the pot in a way. So it's a strange signal to send to tourists. As the rest
Right.
of you have has very often described how all the Southeast Asian countries they are doing everything they can
Mhm.
to
To
attract
get
tourists. Yeah, as a,
the tourist,
what
yeah.
yeah whatever as everything. They want to do everything, and then we have Japan going the other way. So that is actually a bit yeah yeah we know it as you say we
Yes.
it's a bit strange strange signal and yeah what is behind we don't know but still one of these small things that we just note and then say
Mhm.
okay does it mean anything we'll know it is interesting
Yes.
but that happens.
Let's look at that. Let's put a pin on that and we'll monitor how it goes across the parliament. Next, we'll look at Europe this time, Peter. There is a big plan for Blackstone to expand their assets in Europe from a long, long time of, basically holding on to as much US assets that they can as a
Yeah.
policy.
Yeah, yeah. As a Blackstone, we should mention is a giant U.S. Asset manager.
Mm-hmm.
It is of course interesting what these kinds of giants they decide to do. Yeah, and they've been active in Europe, investing into Europe, different ways for 25 years now. They might have, I think it's around 250 billion US dollar they have on the on the balance sheet in Europe of different kind of lending, investments, whatever. Yeah, but they have now announced that they expect to invest 500 billion US dollar into Europe. They are sort of one more, I would say, in the crowd, reconsidering US and also reconsidering Europe. And now we've been talking about, okay, is it just because people are crowding out of US and say, okay, it's getting worse in US, and then on a relative
Mm-hmm.
basis we need to move somewhere else, and then we go to Europe. That is not quite how Blackstone they say it. It is an I would say a positive consideration, but they are also cautious as what they mention on let's say from the high level is that they recognize that the political leadership in Europe and in general, as the political leaders in Europe, they have reckoned that Europe is falling behind now and something needs to be done. And they are Blackstone are also realistic, saying, okay, they can't see that there's a miracle, sort of just a quick fix for
Mm-hmm.
Europe, and they cannot see that European political leaders are pointing at it. So they are cautious, as it's not because they're overly optimistic on Europe as sort of a boom area,
Mm-hmm.
and they actually have expectations that European leadership will do something about it. And there, I think they might have a pinch of the classical US optimism that if something is wrong, you do something about it. Yeah.
Yeah.
It's not always how Europe works. They might be disappointed, and that's the worst thing. Yeah. We need to
So the,
yeah. Let's listen into what Merz is saying. What is he promising when he is speaking domestically? And he's getting asked, so what about the growth? It's 0% now, yeah? Yeah, yeah, well, you could see it in moving up to 2% in 3 years' time. 2% in 3 years. It is nothing when you come from zero. Yeah,
mm-hmm.
that is not ambitious. It is simply not ambitious. So there is a risk that the Blackstone sea level they might be a bit disappointed on that one. But anyway, it is interesting to see where they're going, where they're heading, what do they want to invest into. And actually, you could say they want to invest into to lending to European corporates,
Mm-hmm.
and that is what we when we are talking about funds, alternative funds, is what we call private credit. And private credit is the most hot among the big, large fund managers currently. They're simply taking over uh, the bank's position as a
Uh-huh.
lender to corporate clients, and that is not a bad idea. That is actually is a good, really, really good place to be positioned, and they're good returns. Yeah. So so they're beefing up a business that they have initiated. They want to grow. So they're just expanding that. They're
Mm-hmm.
just basically expanding the lending business in the competition with European banks. That's quite interesting. But that is one. So they're taking over balance sheets. So it means that the European banks they need to find something else. Otherwise, it will be just a net. Yeah.
Uh-huh.
Uh, yeah, that is one thing. It's not that that Blackstone is pouring 500 billions into European startups. That's the only thing that doesn't happen. Yeah. So that's one thing. And then even in the US, they have apparently heard or seen that the infrastructure in Europe is so bad that the bridges are falling apart. Yeah. So they want to go into the infrastructure. And if you look into just Germany, as the government has approved, or the parliament has approved this well-known growth package where they will also pour 500 billion
Mm-hmm.
euros into infrastructure over the next 10 years. So actually, Blackstone will probably be some sort of co-investor if they can. As I
Right.
said, they're sort of following into trying to get into a market where there's a need, and they can get some stable returns, and maybe if they're lucky, they get some government backing, and so yeah.
Mm-hmm.
So the 500 billion, it's a huge amount, but it is not as wild as it sounds. It's actually it's not risk capital in a big thing. Yeah. So this is where they are predominantly moving, but they are moving into one sector that has an interest of us. Well, and that is they want to buy into European companies owned by private equity
Mm-hmm.
funds. And it's well known that particular private equity funds and buyout funds, as the funds that are investing into non-listed companies that are very mature, the most mature, basically they could be on the stock exchange, and
Uh-huh.
typically the companies that are ready to for an
List.
IPO.
Mhm.
These assets, so these companies, they are Blackstone to buy into these. And we very much agree if we sort of remember our every week
Yes.
global outlook, as where we also have reduced our exposure on US listed stocks to exactly non-listed European companies. And that is so we are so happy that maybe somebody at Blackstone or at the sea level are listening to our podcast. Who knows?
Maybe they're
But
listening to you, Peter.
but we agree. So basically, it's where we see some upside. That is actually in the non-listed area in Europe. It's probably a bit undervalued all in all, and there are some pretty good opportunities. So we agree very much there, and that is interesting. We think if we should look into this move, and it is as you mentioned, it is over 10 years I expect to invest.
Yes.
So very interesting. It is, of course, extremely interesting to see what the very big guys are doing in the markets. It simply has a yeah an importance for all of us who are in the financial markets. So that is interesting. What Blackstone has said there. We simply see that as one more flow that is getting into the big picture. That's basically it. But interesting. Yeah. Good, Mel.
We've actually touched upon, gave a preview of our usual global outlook as we usually do. We did touch upon the major regions today in this episode, but I'll start with our view towards Asia. We do look closely with developments, particularly for how what China-focused investors are of interest. So that's
Mhm.
mainly about domestic developments. We see that the tariff war aside, the concern is really what domestic economies are doing to, I guess, push back or lift growth prospects and support further growth. And we see that there is still sunshine in this part of the world. There is a lot of reason to be continue to be optimistic about growth prospects in this region, and that's really why we're so bullish about taking position here, Peter. And meanwhile, the U.S. we've of course made it known that we've downgraded them to neutral, and yeah, the movement is really towards non-listed space, Peter, especially for those young high growth startups in Europe, which is your
Mhm.
area.
Yeah, we like that. Yeah, it's we remain okay. We see the sunshine, no changes, and that's not very often we do a change. That is also to be said. Yeah, as we really have the overall view is long term, and we reckon all the risks ahead, and also that the global growth is suffering a bit from basically the tariff war and whatever
Mhm.
it follows. But um, on the other side, the world is strong. Private households, they want to power ahead as much as they can. And that's very important. There is initiative across the world, and we are not afraid of credit risk either. So we like all in all still to overweight risk, and that is our conclusion also today. So that is not bad actually.
And as usual, we are thankful to our listeners for tuning in.
Yeah, well, it was great to have the conversations with you as always. Thank you.
We'll be monitoring global developments and we'll share what's interesting in the next episode of Sound Economies, Mel and Peter on the Global Financial Markets, a podcast by Longines Investor Insights. Thanks for tuning in. For expert insights on the go, download the Longines Investor Insights app for free. For investors, we offer very exciting and high quality alternative investment funds, including our top rated Mutual China Fund. To know more, visit longinescapital.com.